This is something that I have been very passionate about for many years. Being a mortgage lender and mortgage advisor, most of my career, mainly in Orange County, California, it is one of the most, if not the most competitive markets in the country, just because of the loan sizes and the number of mortgage professionals that were in that particular market. So the concept of pricing and interest rates and comp and all of that stuff was just really curious, and I would get pretty worked up about it many times in my career. And so I'm excited to be able to share this with everybody today. Let's go ahead and dive in. All right. And by the way, we're going to do a giveaway at the end of this that I'm really excited about. I think it will help a lot of you. If you stay to the end, I will make sure that you guys have the opportunity to get this awesome giveaway. I will say too that in a webinar session, it is going to be hard to comprehend 100% of this, right? Not all of it, but there's going to be a lot of questions. There's going to be a lot of uncertainty. I've showed this to thousands of mortgage professionals probably by now. And the feedback I always get is, what the heck? Like, why have I not known this? Why has nobody taught me this? Why is this information not available? And so you're going to want to go deeper. I promise the giveaway at the end will allow you to do that. Hopefully we'll have some time at the end for a little bit of Q&A and back and forth. And I have my team here helping me with some of it as well. This is the second class in our 5-part webinar series. We're doing one a month on how to optimize your business for success in 2025. And this one specific one is about the economics of your mortgage practice, how economic model plays into your future, your production, your growth, and your value as a mortgage professional. I'm probably most excited for this one, and it will continue on the value one that we did previously. I will give you an important disclaimer here. Right? This is not me telling you need to get more basis points. It's not me telling you need to get more of the pie. That's not actually going to help. There are plenty of mortgage companies out there right now who are just saying you could pay a couple $100 and that's it, and you could do your loan here in the kind of discount broker model. There's mortgage companies that are saying, oh, we'll give you all the basis points and we'll just keep a few. That should scare you more than it inspires you, because in a good mortgage partnership, there's enough revenue for both parties to operate at their optimal state. And with the advancement of technology, with the future where this industry is headed, you need whatever company that you are associated with or whatever group you're associated with, you need margin and you need revenue for that company to reinvest back into the future of this business. So any company that's giving you just the bare bones is not going to really be helpful as a partner to you in your future. This is me telling you that you need to know how much is in the pie. You need to know if there's 400 basis points in your loan, if there's 200 basis points in your loan in totality, and then you just need to be confident in how it is shared with you. What percentage of it are you getting? How are you being compensated? Do you just get LO comp on every single deal and it never changes? So we're going to go through a lot of that stuff today. So I'm just going to ask you a simple question here. What if I asked you to start a business with me today? And in this business, you say, well, Ryan, tell me about it. And I say, well, here's the deal. During really tough times, when there's not a lot of business, when margins have been compressed, when everybody is getting hyper competitive, we're going to have to tighten our belt. We're going to have to really make less money. We're going to have to maybe let some people go. We're going to have to stop our marketing budget a little bit. Most entrepreneurs would say, Ryan, that's just what you do during really hard times. That's no big deal. It's not any different for an entrepreneur. And I said, okay, here's the flip side of that, is that when times are abundant, when there's a bunch of extra revenue, when there's a lot of extra margin floating around, we're just going to give the majority of that away to another company. Would any of you want to start that business with me? I would assume that the answer is probably no. It should be no. And everyone says, who would do that? And my answer is almost every single mortgage professional in the United States today has chosen that business model. The business model where when times are tough, you take it on the chin. And when times are abundant, you don't get the upside of that revenue. And that is completely inappropriate. That is not a business that anybody should run. It's not a model that has been available to us as mortgage professionals for quite some time. So my purpose with the call today is to show you the model that I believe will be the only model that real entrepreneurial mortgage professionals will choose into. Look, if your company is giving you leads and if they're giving you business, then they can pay you whatever they want. There's no real argument there. But if you're out there nights and weekends, whether you're a broker or a banker, you're working your tail off, you're doing everything you can to grow your business, support your family, you should be treated like a business partner. to the organization that you work with. And again, this is broker or banker. I'm not saying one is better than the other. I'm saying that there is a business model, an economic model that is the best. And if you can create it or access it or work with your company on it, then by all means do that. But you'll want to do this. And I promise, once you see it, you cannot unsee it. Right? And this will be something that's really important to you and your business moving forward. So let's talk about the plight of the loan officer. When I first started in 2011 is when I really feel like I started my career. I was in it prior to that, but it was just refi, call center stuff. In 2011, I remember I was starting in. Nobody obviously taught me any of this back then. And nobody still teaches it today. It's the industry's best kept secret. I was treated like an employee, not an entrepreneur, not a business owner, not a business partner. And that was true all the way up through 2020. So almost a decade, this was happening to me and to all of us. When we realized that wouldn't be an appropriate business model moving forward, that mortgage professionals would not allow it, we started to make a change. But I know that what happened to me early in my career is I kept asking the question, why? Why is so-and-so's rate half a point lower than mine? Why is credit union beating me by X? Why is a bank beating me by Y? Why is a broker beating me by this amount? And I was a broker early in my career, so I knew the different models, but I didn't understand anything about how that worked. And all I heard from my branch managers at the time was, well, a lot of that is LO comp and all these other things and support. And I just went with it. I generated business in spite of the economics. Being on the executive board of a mortgage company now, owning a mortgage company, I can tell you there is a big conversation happening right now about LO comp. And a lot of the executive behind the closed doors meetings, they're trying to find ways to pay mortgage professionals less. And that's why we've experienced a lot of what we experience in this industry is because people are trying to push back against that. And you should. Mortgage professionals should not be paid less. That business model should be up to them. So if you're wondering, why do I have to sell rates that seem high? Or why am I only paid a certain amount when it feels like I'm selling much higher rates and margins than other people? You're on the right call. We're gonna talk about that and fix that problem today. So the first kind of journey for me into this was I was working in an organization where I was making about 70 basis points and I was doing about 120 million a year. And they wouldn't allow me to run a P&L. And I just learned about this whole P&L thing. And so I said, in order for me to ensure that I'm running a good business, it feels like a good business move to be in a position where I can run a P&L and have more control over the economics. So I did. I went to an organization that allowed me to do that, which is great, and quickly realized that a retail P&L is really just a glorified LO comp. And the reason why is because if you work in an organization where you cannot see the corporate margin, you cannot see corporate profitability, you don't have transparency into capital markets, then that is not a transparent model. They can give you a P&L, but it's not really helpful. Same thing in the broker world. In the broker world, you could be sending your loans to different wholesalers, but you don't know what their margins are. And their margins fluctuate because they're capitalistic, some of them publicly traded companies that need to earn revenue. So one thing I will tell you is that if you are in a P&L model or even a broker model, if you ever ask your company for a price exception and they grant it to you, that should be a red flag. Because in this economic model that I will show you today and help you understand, you should never have to ask for a price exception. You should be able to take one whenever you want because you fully understand the economics, you understand the impact, but getting 700 basis point price exceptions. And I kept getting curious and I was like, what is going on here? Like, why is this happening? I can't wrap my head around why in 2018, when margins compressed, I was called and said, hey, margin compression's here. We're going to have to really crack down or we're going to pay you less and so on and so forth. That seems fair. It seems like when times are tough, we should all tighten the belt. But then in 2020, when margins expanded, I figured, well, at this point, if margins are expanding, I should probably get a phone call saying, well, now we're going to pay you more. That phone call never happened. And so that was, for me, an opportunity to say, what's happening here? What's really going on? And so myself, and there were about 3 or 4 others of us at different organizations. This was not one company. We knew a lot of mortgage company owners in 2020. And we just asked, we said, hey, look at the rates we're selling and please tell us the margins. There were 600 basis points in our conventional margins. There were 1,100 basis points in our government margins. And we were getting the same amount on every single loan. same amount that we were in 2018, 2019, 2020, so on and so forth. And when I realized this, I said, hey, this doesn't seem equitable. And they just said, look, that's our business model. And it was that moment where I said, okay, well, they see me as an employee, not as a business partner. And I said, but this is happening to me. It's happening to everyone. And then it was happening in the broker space as well. All the wholesalers had raised their margins. Now, they didn't raise them as egregiously because they still had to play in a more open competitive market, but they were probably making 400-ish basis points on conventional and maybe 700 on government. And again, every one of the brokers was getting the same amount on every single loan. And so when you see these massive spikes in mortgage companies' profitability, it is largely due to the fact that when margins compress, everybody feels that. But when margins expand, all of that upside variable revenue, it goes to the company, whether it's the wholesale company or the retail company. But it never goes to the originator other than just doing more deals in a lowering rate environment. I just couldn't wrap my head around, like, if I have to give up revenue in hard times, which I understand, I should be able to benefit in abundant times. And that's just not true in the modern mortgage space as we know it today. But something that I'll teach you here and show you here in just one second. So we went on this search for transparency and for control. A lot of us saw this in the exodus from retail to bank. We saw people just in droves go to the broker world. And what we realized is people didn't actually want to go broker loans. It's not as effective, but they just didn't want to be in the uncertain, lack of transparent, behind the iron curtain world of retail. So it was really more running away from a retail. And we could understand that. That made all sense in the world. But it still didn't give them the transparency or control that they were looking for. That's not what wholesalers offer. So again, this is not which is better, wholesale or retail. I think both of those models are broken. I'm going to show you the one model that works in every single market, bad and good. So you have complete control, autonomy, and transparency in what it is that you do here. So let me show you. This is pricing that was pulled this morning. So what I'm showing you here is in a typical retail setting, this is going to be over here on the left, what's called raw correspondent pricing. So if you work at a retail organization, the correspondent lenders, these are people that buy these mortgages. So this is going to be your PennyMacs, your Mr. Cooper's, your fill in the blank. It could be Flagstar previously, but there's a bunch of different correspondent banks that put out bids and prices for mortgages. Wholesalers get the same correspondent prices because wholesalers oftentimes sell those loans to the same correspondent investors that retailers do. The difference is raw correspondent price doesn't have margin variability the way that wholesale does. So what you'll see here is today's best correspondent price is at 6.375, and that's at basically 9 basis points above par. We have about 80 or so of the best priced wholesalers in the country that we look at because we also can broker. So we can pull a list and we can say, okay, the absolute best price wholesale in the country is Provident Funding. And if you all know about Provident Funding, you can take it or leave it. But you can see that we're about on par from a correspondent price to a wholesale price. You can see we highlight the two kind of major wholesalers. So Rocket is at 99.89, which is about 20 basis points worse of a price. And then UWM's base price, and I know they have incentives and they have other things that they do, but their base price is 99.6, which is, call it 50 or so basis points worse than a correspondent price. Now, here's the thing. This is a raw price. So a retail bank would put its margin on top of this price here, and then it would give a branch price, and then the branch would pay the loan officer. So I'll show you the model here that you need to work towards, but I just want to explain the difference between correspondent and wholesale. When you get into government, you see the gap widen. FHA, the best price FHA is at 5.625 this morning, 100.557. That means there's 55.7 basis points at a 5.625 on an FHA loan. We can see the best price is NMSI, which is 40 basis points worse. Rocket is 55 basis points worse than a correspondent price. And then you see UWM's base price, again, no incentives, is going to be about 130 basis points worse than standard correspondent price. And look, this isn't just my company. It isn't just this company. This is correspondent pricing that goes to every correspondent bank. Every correspondent bank fill in the blank XYZ mortgage would have a similar execution, if not a very almost exact same execution, because we're all getting correspondent price from the same lenders. And then we see here VA. So VA, very similar, 5.625. We're about 50 basis points better than Principal, who's number one. We are about 80 basis points better than Rocket, and again, another 80 or so basis points better than UWM. So why am I showing you this? Because every day, these wholesalers are going to change their margins. Some get better, some get worse. It really just depends upon the profit they want to make. And now I'm showing you this at the most margin compressed time in the industry, where it's just a really tough environment out there. What happens is as rates start to go down and as capacity starts to become a little more challenged and as companies want to start making a little bit more profit, what happens is your retail banks, they're going to put more and more margin on top of this raw correspondent price without ever telling anyone. That's why we all feel like, well, why do my rates feel out? Why do I feel like I'm selling something higher? And then the same thing happens in wholesale, right? Now, obviously, they need to stay competitive and they need to stay in the same range, but these are all capitalistic money-making organizations. They need to add revenue as well. So they're going to start increasing their margins. But as a broker, you get paid the same on every deal. And as a loan officer, you get paid the same on every single deal. So what happens is margins expand, all the revenue goes to the retail and wholesale organizations, but it rarely goes to you as the entrepreneur and as the owner of your business. So let me show you this next slide here. Margin control matters. And what I mean by margin control is you as the originator, right? You as the business owner, you need to have full transparency of all of the revenue of every dollar in that loan. Again, you don't need to get every dollar. You just need to be able to know it. You need to be able to see it. And as it stands, outside of our organization, I haven't seen another organization do this yet, but to show every basis point up front, full margin. And when a loan funds, you can actually ask the company for a purchase advice document, and that would show every dollar they made on that loan. And then in the wholesale world, again, you only see what they're willing to pay you, but you don't see what they are earning on their side of the equation. And that is by design. So we went on a journey to find an organization that would allow us the transparency that we were looking for. And we thought we had it because they gave us full transparency into the front side of the margin. But there is a wizardry in capital markets. I'm going to share this here. Okay. For those of you who don't know, when you lock a loan, if you lock it mandatory, which is most of the time at an organization, whether it's wholesale or retail, your organization isn't actually locking that loan. They are taking an insurance position out against that loan. And then the goal of capital markets and the secondary team is to make revenue when they sell that loan. It'll usually average between about 25 to 50 basis points, can sometimes be as high as 100 basis points. And if you're in a market with low loan balances, it can be as high as 200 to 300 additional basis points on the backside of a mortgage. Those are called spec pool markups. Those are called CRA pickups. Those are just, those low balance loans are more valuable because the payoff is a longer duration. But ultimately, capital markets is something that you need to really understand as a mortgage professional. The way that we got caught with it was that, again, we thought we were getting all transparency, but the organization was manipulating the front side of the rate sheet in order to earn revenue when they sold the loans. They'll add an extra 5 basis points today, an extra 10 basis points tomorrow. And look, we're busy mortgage professionals. We're not going to be able to dissect capital markets to figure out if 10 basis points are there. So what happens is all of a sudden cap market starts to grow and it starts to pick up. And we're in conflict with the organization because our job as the originator is we need to go sell a competitive rate that also pays us a fair margin so we can run a good business. What we learned is a mortgage company cannot, and I want to stress this, cannot say the word transparent unless they show out all cap markets and unless they allow you as the originator to participate in those capital markets. Because if without it, there's just no way you actually know if there's a secondary strip that's added to your mortgages, if you're getting tier 1, tier 2, tier 3 correspondent rate sheets. And so really understanding what happens when that loan is sold, that's another revenue event. And as a mortgage professional, you have the right, in my opinion, to participate in that capital markets opportunity. So I'm going to show you something here that I think will help because this is the model that we recommend. We recommend it for every mortgage professional that has the ability or the desire to have complete margin and revenue control in relationship and in partnership with their organization. So I'll show you what that looks like. Okay, so this is an example of a Proforma based on the economic model of the future. If you see this, you can't unsee it. Buckle up. This margin here is the total margin on the loan, and you should be able to select it. You should be able to tell your organization, hey, I want 350 basis points in my conventional margin. I want 450 in FHA. I want 450 VA, so on and so forth, right down the list. I want 400 basis points in my HELOCs. And this isn't your branch margin. This is the margin for the entire organization. So if you fund a loan and you don't take a price exception on a conventional loan, you should be absolutely certain that 350 basis points just came into that organization. Right? And if you want this to be 250, then make it 250. If you want it to be 450, then make it 450. It's your business. It's your clients. It's your demographic. You should have complete autonomy to set that where you want to set it. And again, this is not LO comp. This is total margin for the organization that comes in. Now, what happens is we would proform out where you want these to be. We'd let you know, okay, what rates they'd be associated with. And oftentimes we will show these rates to people and they will actually be better priced than the wholesale market because again, they have to add their margins. They'll be better priced than the retail because they're not used to getting the entirety of it. And then what we do is we encourage you to split that revenue with the organization in this capacity. This isn't our organization. This could be your organization. There could be mortgage company owners on this call today that really want to create a better business model for their people. We believe that the only way to create alignment between the mortgage professional and the mortgage organization is if every basis point is accounted for. We'll just use this at 350 basis points. And then if this is your product mix, you do 60% conventional, you do 10% FHA, you do 10% VA, jumbo broker, 10% HELOC. Then let's say that branch or that cost center owner would have brought in 366 basis points to the organization. And the way that it works is for the first 280 basis points, 75% of that revenue goes to the mortgage professional. From 280 to 380, 80% of that revenue goes to the mortgage professional. So you can see in this particular situation, the branch ends up getting 76, the organization ends up getting 23.82. What the kicker is here is cap markets. Because again, a company could allow you to put in total margin, but they could have secondary strips in, they could have all these other things to inflate capital markets, and they'll say, look, we'll let them put in whatever margin they want. But when we manipulate it, we'll get most of our money on capital markets pickup. Again, the only way to prevent from doing that and create transparency and alignment is that if capital markets is also shared. So we assume, let's say 25% capital or 25 basis points in capital markets. In that case, as long as the revenue is 280 or above, in this case it's 366, then that originator actually participates in 75% of the capital markets on a quarterly basis. So every quarter, the mortgage company should share capital markets revenue up to 75% with the people that created the capital markets revenue. Like these are people that are out there bringing this business in. So why does this create alignment? Because if, let's say I'm the branch leader, I'm the cost center owner. In a normal retail branch, I could take a pricing exception at my branch level, but the mortgage company makes the same amount of money every single time. So there's no alignment for them to help me get better, to hold my margin, to have a value proposition like we talked about on the last call, because they'll say, look, you can go as low as you want. It's your P&L, but we're going to make our money. That's not alignment. What should happen is if I take a price concession, the company should take it with me. So if I take a 100 basis point price concession, now this is 250. Well, that means that I'm making 75% at 250. The company's making 25% at 250. And it's a lower number. Neither one of us want that. So both of us are aligned to help get better. But no one has to ask for a price concession because it's our collective revenue together. The organization and the originator both know how many dollars are there. The originator is incentivized to hold a good margin because the higher margin they hold, they get more of the profitability of that margin and then ultimately participate in a higher level of capital markets. And this, for example, just so you guys have a good understanding of it, we assume this is a $30 million producer, someone who helps 74 families per year. We assume that they pay themselves 100 basis points in compensation. They have a production partner to help run their business. So they pay them a salary and a bonus. They also have a credit analyst and a loan specialist that help them to where they do the majority of the work on those loans. So they have 3 team members supporting them. We have all the expense inputs. We have gifting for client gifting. We have client success manager for all the post-closing things that happen. And then we have all of the technology, all the different things that somebody would want in a tech stack, all built in. And then ultimately, it shows that this branch would bring in about $869,000 of revenue. They would have expenses, they'd have a net income, they'd get cap markets throughout the year. So that branch would end up making about 195 basis points after expenses are paid, after 3 teammates are paid to do the work so they can focus on what they do there. And then ultimately, as they scale their business, because they have the teammates, they have the technology, they have the consistency, that can end up being about 215 basis points on 60 million or about 1.3 million in total revenue. But again, this is not a you have to sell this margin. People think, I can't sell a 350 margin. You kidding me? There's brokers out there that are doing it for 150 or 200 all in. Okay, that's a value problem. And if you have a higher value, you can hold a higher margin. But if you need to go down there, you can. You can put a 200 basis point all in margin. No one is telling you what to do. No one is telling you how to operate your margins. You are the decider of where you want your margins. And when I say yours, it's the entire organization on the loans that you fund. And then you get to participate in a percentage basis. This is full transparency. This is you being the business owner in partnership with the mortgage organization, giving you every opportunity to be successful. Now, I do want to tell you, this is something where I believe margins matter. So let's think of the goal of any business here. So what is the goal of any business? First of all, we need to solve a problem or meet a need for customers. That's value creation. We just did a webinar last month on value creation. We should be the most valuable mortgage professionals, the most valuable mortgage relationship for any of our clients, business partners, teammates. That's clear. We need to deliver a solution profitably. Otherwise, we're not a business, and you cannot take home too much of the revenue. That's what we see mortgage professionals across the country doing is they say, I'm just going to make 150 basis points so I can be hyper competitive. But then at the end of the day, I don't have any money to grow. I don't have any money to invest in technology. I don't have any money to invest in scale or teammates. I don't have any money to invest in marketing to grow the business because I'm just not bringing in enough margin because I think I need to be the cheapest. That's not a winning solution. A company needs to build trust and loyalty with customers and stakeholders. So if you know that you're getting the absolute best correspondent price every single day with no margin manipulation at all, and you are aware of every basis point because you choose it, then you should have trust and loyalty with your customers because you know exactly where you are. Doesn't mean you're going to be the cheapest. It just means that you believe your product is going to be the most valuable for the price. And the stakeholder, a lot of times you might be the only stakeholder in your business. So in order to build trust with a stakeholder, which is yourself, you need to know that you have a consistent economic model that cannot be manipulated. And again, wholesalers manipulate margin, retail banks manipulate margin. In this model, where it is a business partnership model, transparently, you are the one who manipulates margin. It's all your margin. It's just in collaboration with the organization. So you do get trust and loyalty with that. Next is generate a return, make a profit. This is a sometimes missing piece in the puzzle. There's a lot of mortgage companies that are not profitable right now. And it's because there's a disconnect. There's a fundamental divide between the goal of the loan officer and the goal of the organization. So loan officer wants to sell the lowest rate, the cheapest cost to as many people as possible so they can get their LO comp. It's just human nature. It's what we should all want to do if we are treated like an employee. The problem is they go to the bottom of the rate sheet. They ask for price exceptions. They get them sometimes. They don't get them other times. And then the organization struggles because they're not profitable. And so they think the LO comp and these other problems and cost of fulfillment. It's really hard to make a profit when you don't have alignment between the origination team and the entity, right? Like this solves all that. It puts everybody on the same page. And then lastly is expand impact. And team, this is an incredibly important one. Margin allows you to help more people. Bottom line, if you don't have the appropriate margin, which means enough money to take home, to pay your bills, to invest, to grow your own personal wealth, but at the same time, to reinvest back into the organization, technology, lead generation, marketing, hiring, scalability, all the things that every business does, every successful business does, you won't be able to help that many people. I'm a good example of this. When I first started, I struggled getting past 2, 3, 4 loans a month until I realized, oh, I need teammates, I need technology, I need marketing. And so, I had to make sure that I was doing enough business to reinvest in that. But it was like a cart before the horse type deal. What I just showed you is you have 3 teammates, you have all the technology, you have all the stuff you need in the world, but you also have a good amount of money to take home. It's not an and/or situation. So I want to show you why margin matters and how margin matters. This is just a snapshot of some of the branches in our organization. And again, this is not a recruiting thing. This is not a come work at Neo thing. This is an awareness thing. The branches in our organization, some of them are making close to 500 basis points, all the way down to 230. But they are selecting this in their market based on their demographic, based on their clientele, based on their product mix. This is not something that they have to do. This is something that they get to run their business this way. And then ultimately, this is what the branch ends up earning on these deals. This is a product of having transparency. And this is front side. This is not even considering capital markets. That comes later. And so I know some of you are going to be looking at this thinking, oh my God, how are you getting away with getting that much margin? And I can promise you, we're selling almost the exact same interest rates. It's just you're not keeping as much of the margin. The wholesaler's keeping the margin, the retail company's keeping the margin, or you're selling rates that are lower because you believe that you need to be cheaper in order to earn people's business. This is clearly not the case. When I say margin matters, you have to have a business that is transparently offering you the ability to maneuver with the market, because margin expansion and compression happens every single day. Companies are going to increase their margin, they'll decrease their margins, they'll move them all around. You just want to be the curator of that, because think about it, supply and demand are going to change. Right now, there is a ton of supply of mortgages, but very little demand. That means that we all need to get a little bit skinnier. We need to try and tighten down and making sure we're profitable. But 6 months from now, if rates come way down and we have capacity challenges because not everybody has massive teams of underwriters just waiting for loans, that's when companies start to move their margins up. In our world, that's our branch leaders, that's our cost center owners. They get to move the margins appropriately. Like, in what business would you ever want to make the same amount every day on every item? Sometimes the cost of fulfillment goes up. Sometimes we're seeing it with tariffs right now. What if all of a sudden they said, hey, it's 20% cost increase to create a mortgage, which we've, by the way, been seeing every year for the past decade. Well, if costs keep increasing, margins need to keep increasing. But then if costs decrease, like, you have the opportunity to decrease margin, or you could hold margin and create the difference in profitability for yourself. But you cannot do that as a broker. You cannot do that as a non-transparent retail originator. You have to be in partnership with your organization where you know every dollar, they show every dollar, front side, back side, and you guys agree collectively on how much of it is necessary to run your business, how much of it is necessary to run the organization's business. And I promise you, it creates a massive amount of opportunity. So what does this equate to? And then we'll open it up and answer some of the questions. I can see some questions in the chat here. A mortgage advisor will always trust their price. If you've ever thought, oh man, why do I have to sell this rate? This rate seems high. I think we're out of the market. Or if you're a broker and you continually send your loans to 1, 2, or 3 organizations because they're great. They do loans fast, they close on time, they are good customer service, their systems and their technology is great. That's awesome. But as you can see, sometimes those bigger players don't really give you the margin. They're holding that margin. And it's not like they're getting a worse price than we are. They might even be getting a better price. They're just not passing it through to you. They're keeping that as revenue and they're keeping that as profit. So if you're wondering why your price may not be as sharp, or why it feels like it's happening to you, this type of model will completely get rid of that, because you'll know you always have the best price. You just may have a competition problem. Nobody's going to have a better price than you, but there will always be people that will be willing to do it for less than you. Then I would just say, go watch last month's webinar for value and then say, well, what is my value? Like, why should my margin be higher than the next person? Second thing is, both the company and the production team win and lose together. And that is super important. I, for almost all of my retail career, never felt like I was on the same page as a business partner of the organization because they never made it feel that way. If I said, hey, I need a 100 basis point price exception on this deal, and they say, okay, all right, you can have it, go get it. I'm like, wait a minute. That just mean if I didn't ask for it, they would have just made an extra 100 basis points? Yeah. What if the wholesaler is all of a sudden offering a 60 basis point incentive? We're going to give a 60 basis point incentive for the month of April on refis or purchases or whatever. Okay, so does that mean that every other month that we're just giving you an extra 60 basis points? Because again, you're the business owner here. This is your business. You're in partnership with the people you are choosing. So why not just put every basis point on the table and allow business partnerships to openly look at it and say, okay, yeah, we'll do this, you do that, let's do it together. So in almost 2 years, no one's come to us and said, I think our price is out, because they know that can't be true. We just have a raw correspondent price that is always amongst, if not the best in all of the products. So that level of confidence comes through when you're talking to clients. And you'll be able to easily know, oh, like they're being offered a rate that's half a point lower than I'm offering them. Okay, well, let's do the math. If I went down a half a point, that means that I'm going from 350 down to 150. Okay, so that means that my competitor is willing to do that deal for 150 basis points all in. Now, you as the professional and the business owner, you get to make a decision. Do I want to go get that deal? Do I want to do it for 150 basis points all in? Is that where I want to be? Do I believe I'm more valuable at that? Should I tell the client, hey, I'm not going to match that because I don't believe that you're comparing apples to apples? Go back, watch last month's value proposition and say, you think that we're the same, we're not. We do all these things before, during, and after. So maybe I'll meet you in the middle. I'll be a quarter higher so I can make maybe 250 as opposed to 350. But that's where you should be, Mr. and Mrs. Smith. Okay, great. You just saved yourself an extra 100 basis points, but you have the ability to do it. It's all up to you. And you never need to worry about, man, I think that something's happening to me. You just can easily see, it's like the matrix. You open up everything and you just see every basis point, and you could just do math and make a business decision. And then ultimately business owners can act and operate with revenue that allows them to grow. You just need that revenue to grow. And it always makes me chuckle when people say, oh, my company gives me a ton of support. They hire people for me, they do all these things, they do marketing for me. And then we do an analysis and they're making 100 basis points, but their company's making 250. It's like, sure, they're going to support you. They're going to probably give you whatever you need because they're taking the majority of your revenue. And it might feel good, but that's not a business owner mentality, right? And the mortgage professional of the future absolutely has to have a business owner mentality. It can't be something where you just blindly trust that everything is going to work out. You need to own this part of the business. And it's not easy. Learning about capital markets, understanding about when you get your secondary bonuses and how that all works, where you need to price your loans. It's a lot. Like our group has been doing it for 5 years now, and we are still learning. We're still improving upon it. We're still making it better. But it feels a lot more empowered to be that than the other side of the equation. What can you do with this information? I know we're coming down to time here. You can take it to your organization if you're at a retail organization and propose that they open up all the basis points and let you see them and let you participate in a fair manner where both sides can win. If you're in the broker model, I'll be honest, it's going to be really hard because wholesalers are never going to give you their capital markets. They're never going to create a fully transparent model. They're always going to have their corporate margin and they're going to pay you what you're paid. It's also hard with the way brokers are paid to be able to operate that way. You have the ability to make this information. And look, we are independent. We are entrepreneurial business owners. And the mortgage industry has done a phenomenal job at convincing us that we should be employees. We should not. And it doesn't matter if you're a 1099 broker. If you don't have 100% transparency and control and maneuverability within your margin, you're still an employee. You're just a contracted employee. If you work at a retail organization, you're definitely an employee, right? Because you're just getting paid whatever they want to pay you. But we shouldn't. We're out there, we're doing the work, we're getting the business. We should be treated like business owners and like business partners. So you can do with this information what you want, but having it is helpful. I will send out this recording so you can get a few of these slides that I showed you, a few of the pieces of information. If you just do me a favor, like just either follow me on LinkedIn or Instagram, Facebook, ideally not, but you can if you want. Shoot me a message on one of those platforms and just let me know what you thought of the presentation today. I'm assuming you're going to have a bajillion questions because this is all a lot of information and it's sometimes can be overwhelming. But if you do that, I'll send you the deck and I also send you a link to schedule time. So this is kind of the giveaway. I'm happy to offer a one-on-one analysis of your business. I've been doing this a lot with brokers lately, and it is pretty mind-blowing for them because they really did believe that by going to the broker channel, they were maximizing revenue. And that's clearly not true. And look, you might get, well, you say, well, 150 basis points, I only pay my broker $500. You sure are maximizing revenue, but you're not maximizing it from the wholesaler. You're just maximizing it from the broker. Understanding that's going to be super helpful, whether you're a retail or wholesaler broker. We'll do a one-on-one analysis. We can do a pro forma. I can show it to you. This is just your opportunity to see what your business could or should look like in a environment where you are given all of the opportunity. You're given all of the information to own and run the business. Probably wouldn't take more than 30 minutes or so, and you'll get a lot more of your questions answered. So just, again, follow me on LinkedIn, Instagram, shoot me a message. It doesn't need to be public because I know that publicizing this sometimes can be a little interesting. And then we'll go ahead and we'll schedule some time and we'll go through it with you. Let's do this. Chris and Deb, is there any questions that came up that would be good for me to address that you all saw?
Yes, we got some questions, but John has his hand up. So maybe we start there first and then we can work through some in the chat.
Cool.
Can you hear me?
Okay.
Yes.
Yeah, we got you.
So I work for a non-debt lender. So we're broker. Okay, it's you mortgage. Essentially, the branch sets the margin at 250 and pays me 125. But I think that there's other margin that's being made by the company outside of what's being published, like in our software. What's the likelihood of that, you think?
Yeah, so John, I'm not going to hypothesize on that because I don't know. But what I'll say is anytime someone says the word branch margin, it scares me because branch margin means that that's what the branch gets paid. But if you don't know the corporate margin, then who knows? It could be 200 basis points in corporate margin. It could also be 5 basis points in corporate margin. And I've had plenty of people come to me in the last couple of years and say, I think my company is taking advantage of me. And we actually do a pricing scenario and I say, your company's actually losing money on you, man. Like they're skinny and we wouldn't touch them. We'd be like, sorry, like you're losing money for them. You'd lose money for us. But they don't know that. And that's the biggest problem is that whether your company is keeping all the money or actually losing money on your business, if you don't know and you are losing deals, then the default is, oh, I'm losing deals because my company's got too much margin. We're not competitive. That should never cross your mind. Like we're not competitive should never come into your wheelhouse. And so if you want, John, shoot me a message. Happy to walk through with you. All you would do is you would say, here's the rate I'm selling today. Here's the margin I'm getting. And I would tell you exactly. I'd say, here's how much is in that, right? In total margin.
I'd appreciate that. It seems like basically there's just a lot of smoke and mirrors. Essentially, it's listed in our software that the margin's 250. And I think they pay the corporate office like 45 basis points. What the question I had was this: is there additional basis points above and beyond what
it's likely because they need to make profit. And
team, they are. They're charging the branch 45 basis points per
loan. I'll be honest. It takes any decent, reputable mortgage company, including Wholesale, about 75 basis points to run what I would consider a decent business. If they drop below that, it's going to get pretty challenging. If they get above it, it gets more profitable. But again, it shouldn't be a question. So Brendan actually wrote in the Q&A, says mortgage banking with transparency is an oxymoron, like jumbo shrimp. I love that analogy. But it doesn't have to be. It shouldn't be. It just has been for decades. Right? And the mortgage professional of the future will not stand for it. And being a broker is not helping. All it is thinking that you have multiple options, which by the way, retail lending has multiple options. They get 30 different correspondent investors that give them the best price. The same way that you might have 30 different wholesalers giving you the best price. But if margins are changing and moving and the company that you really want to use is not giving you the best price, and now you have to go to XYZ wholesaler and you have to fax in your documents, like it's a problem. So don't choose what I would consider a less consistent, less deliverable product just because you're searching for margin. You don't have to choose between the two anymore. It's there. What else, team? Deb, Kristen, anything else in the chat that you guys see?
Oh, so sorry. I was still muted. I got super excited. So from Nick, we have a question. Does volume from a company play into pricing from a wholesaler? And I could see in the chat some folks are jumping into that answer, but anything you want to expand upon, Ryan?
Yes, it can. There's a lot of things that go into a correspondent price. There's a lot of things that go into wholesale price. So what'll happen sometimes is if you work at a broker that delivers a ton of business to a ABC wholesale, they might give that broker an extra 25 basis points or 50 basis points or run special. But here's the thing. What if they don't, right? Or what if the broker, and this I see this a lot, the broker ends up keeping that 25 basis points and they don't pass it to the originator. So they use that as a profit center. So they may only be charging you $500 a file to be at their brokerage, but meanwhile, they're getting 25 basis points from the wholesaler as a backside pickup that nobody knows about. And that's not okay. If they're getting it, you should know about it. You should be able to participate in it. That's like a capital markets event for a broker. It's the same concept. Like this is the easiest way I could put it. If any business model hides a dollar from you, whether it's on the front side of the margin or backside capital markets, that is a model that is really hard to trust. And you as a business owner have to trust in the business model. And look, I know this is not an easy thing to talk about. This is going to piss off a lot of mortgage companies. It's going to piss off a lot of wholesalers because no one's ever opened it up like this before. No one's ever showed every dollar front side and backside. There's a billion companies out there that are saying, oh, come work for us. We give you more of the money. How do you know? Ask, are you transparent? Yes. Okay, that means that you show us capital markets and we participate in capital markets? Oh, no. Okay, then you're not transparent. Stop saying it. Well, can I see the purchase advice document on every loan that funds? No. Okay, well, you're not transparent. Stop saying it. That's the partnership you need. Because again, it's not about being the cheapest. It's not about getting the most basis points. It's not about doing it for the least basis points. It's about having control for you to operate your business with the most amount of empowerment to have your margin where you want it to be. I just saw Peter Jerf put this in, and I'm trying to keep up with this here. It says, why are you the first one to speak openly about this? To be honest, Peter, is because I felt really pissed off when I found out about it. My group was doing $1.5 billion for an organization that was making hundreds of millions of dollars and paying me and my team the same exact amount when margins went through the roof. And then we said, well, do we have to go broker? And then we looked at it, we said, no, broker's worse because they increased their margins too. But now it's just inefficient because now we got to go to different places and use different systems, right? So we created a model, and everyone says this. They say, well, how are you the only company to do this? We're not going to make as much money. We're not going to buy 70,000 square foot homes. We're not going to own NBA teams. We're not going to sponsor golf tournaments. We're not going to have private jets. We're not going to have ranches. Look at almost any mortgage company ownership, and it's pretty clear to see where the revenue goes. So we just started a model that says we don't want that anymore. And are we going to be billionaires? No. And look, we make $0 less than any other organization. We just distribute it differently. It goes where we believe it should go, where I would have wanted it to go as an originator. And as an organization, we still make good money and can be profitable to run a great organization and invest in technology and lead generation for our teams. You don't have to choose. But the mortgage industry has become so divided because the loan officer wants the lowest price and the mortgage company wants the highest amount of profit. Those two things are diametrically opposed. All right, we only have 2 minutes left. I could rant about this for a very long time. I genuinely hope you all take me up on my offer. Shoot me a message on social media. We'll spend the time. And this is not a recruiting thing, I promise. Some of you are probably better off just going to your organization or going to your wholesalers or going to your broker or doing whatever you can and just saying, this model exists and I won't stand for not having it. And once you start to see, if you do this exercise and go, wow, there's 200 extra basis points in that deal that I didn't know about, you can never unsee that. So I genuinely hope this is helpful. I will share this last slide. Please don't make this your last webinar. Again, we had our first one on value proposition. If you did not watch that, please watch it. It will, having high margins is impossible without a value proposition. You cannot get good margins without a good value proposition. Hopefully this economic model taught you a lot. On May 15th, we are going to talk about lead generation, which is one of the most challenging things in the market today. So 8 pillars of lead generation and how to accomplish it. You're going to want to come to that one. On June 19th, we have the coming wave of technology. This is going to be bringing this all together because technology is going to lower the cost of fulfillment. It's going to lower the number of people we need to hire. It will increase our scalability, where we should be helping 50 to 100 families per month. And as we lower costs, we can start to decrease margin and make the same amount, if not more money. So June 19th is going to be really important. And then lastly is going to be the power of community in all of this. I don't think any of the first four things work unless you're around the right people in the right community. I will let you all jump. Have a wonderful day. Thank you guys. Message me if you want more information, and I'll look forward to seeing you all soon. Thanks, team.